In today's video, we're going to be doing a full case study breakdown on a real property here in Brantford, Ontario. This is a legal non-conforming duplex listed at $549,900. And we're going to analyze if it actually cash flows. We're going to be looking at two real-life investment strategies. One where you buy it as an investor, and one you buy it for house hacking, one of my favorite strategies, especially for first-time home buyers. And this is where you live in a unit and rent the others. Hi, my name is Catherine Pimentel and I'm a local realtor here in Southern Ontario. And my mission is to educate aspiring real estate investors. So let's get started. Here is a property that we're looking at, 19 Brighton Avenue in Brantford. As I'm talking a little bit more about the property, I'll have photos of as is as well as virtual staging. So it's a legal non-conforming duplex in Brantford in Eagle Place neighborhood. Both units have 2 bedrooms plus a den. There is separate entrances and they have their own hydrometers. And unit 1 on the lower level has in-unit laundry. It sits on a pretty large lot, 41 by 132 feet, which leads to the opening door of an ADU. And we'll dive into a little bit more about that later. Before jumping into the two scenarios, let's quickly break down the renovation costs. So the estimation is approximately $50,000. New flooring for both units, so for the full building, approximately $10,000 to $14,000. For painting, walls, trim, and ceilings, about $6,000 to $8,000. Ceiling repairs in the den, about $2,500 to $4,000. To add a laundry into the second floor unit, about $4,500 to $7,500. General fixes and finishes, about $3,000 to $5,000. And I added another 10% for contingency, just in case of other surprises come up. This brings us to the total of $29,000 to $43,500, but I run it up to $50,000 just to have a more conservative approach while looking at this property. Okay, so now let's look at scenario 1, the investor buyer, meaning that you're going to be renting the full building, so both units. If you purchase a property for $550,000, you'll put 20% down, which is $110,000. Renovation budget is $50,000. So here's a mortgage calculation. Purchase price minus the down payment plus renovation budget, and that equals $490,000. With the current interest rate at 4.59% at the time of this recording through a bank, in a 25-year amortization, the monthly mortgage comes to $2,736.59. So that was step 1, the purchase costs. Now let's go to step 2, which is the rental income. Looking at other rental units in the area that have leased, a 2-bedroom and 1-bathroom unit went for about $1,800. And because there's 2 units, $1,800 times 2 brings us to $3,600. So that's our total rent. I set aside 20% for the operating costs, which brings us to $720, 20% of the rental income. Let's break down what operating costs are. It's property tax, insurance, vacancy, and maintenance. I allocated 3% to maintenance and 3% to vacancy. Maintenance is anything from if a toilet needs repair, new sink, the stove or fridge breaks down. Every month you set aside a small amount so you're prepared when those come. By setting a small amount for vacancy, also you're prepared for when the property is vacant, that in between time when a tenant leaves and a new tenant comes in. And the remaining 14% will go towards property tax and insurance. Now, a side note for this, each property is unique, so the insurance might be a little higher or lower than what is estimated here, but this is just an average and standard across all properties. And it's just used so we can have an idea for this example. So that's where the 20% for operating costs come from. So let's continue, which brings us to net operating income, $2,880. Step 3 is netting the cash flow. So the cash flow is our rental income, which is $3,600, minus the mortgage, which is $2,736.59, minus the operating costs, which totals to $143.41. So this is your cash flow at the end of the month when you rent both units. But now let's look at the scenario of adding an ADU. In Brantford, you currently can have 3 units on a residential lot if you have enough space and enough parking. 1 parking per unit. And this property has that parking space, which is great, and also a large lot. Let's break it down. The cost to build an ADU in this scenario I did was a tiny home, which averages to about $150,000 to $200,000 here in Southern Ontario. So I went right in the middle at $175,000. Now the new mortgage total is $665,000. So $175,000 plus the mortgage from the other example is $490,000. So added those two together, that's where the $665,000 comes from. Now our new monthly mortgage is now $3,713.94. Rent from the tiny home would be approximately $1,800 still, 2 bed, 1 bath. Now your total rent is $5,400. New expenses, so the operating costs, 20% of that is now $1,080. Now the cash flow is going to be $5,040, which is our rent, minus our mortgage payment, minus our operating expense, which brings us to $606.06 every month. You can see with 2 units, you're slightly positive, net positive, right, with about $140 a month, which isn't too bad, but by adding an ADU, you can see how much stronger the cash flow is. It's a lot more positive, so $600. So the key takeaway is the more units you can have on a property, the more it cash flows. So that was scenario 1. Now let's look at scenario 2, which is house hacking, living in 1 unit and renting out the others. Perfect for first-time home buyers, or especially perfect for those trying to avoid the 20% down because you don't have to when you're living in the unit. So let's check this out. So the down payment needed to buy this place for $550,000 is $30,000. Where did this number come from? So it's 5% on the first $500,000 and 10% on the remaining. So it's 5% on the first $500,000 and 10% on the remaining $50,000, and those two numbers added up equals $550,000. Renovation costs are the same in this scenario as well for $50,000, and as well, because you are not putting 20% down, you do need CMHC insurance, which brings us approximately to $20,800, and this is going to be spread out on the whole mortgage amortization, so you're not paying this up front. Our new mortgage amount is $520,000 for this scenario for house hacking. Now we're going to break this down into 2 further brackets in this scenario: first-time home buyers and those that have already purchased a property before. Because if you're a first-time home buyer, you can have a 30-year amortization, meaning that your monthly payments are stretched out further compared to 25 years. Now it's 30, meaning that your monthly mortgage payments are going to be lower, which is great because you can cash flow better. So let's take a look at the first-time home buyer example. Amortization is 30 years, so your monthly mortgage payment brings us to $2,760.48. If you're not a first-time home buyer, the amortization would be 25 years long, and your monthly mortgage payment is going to be $3,020.30. So you can see it's about a $250 difference. Now let's go into step 2, which is renting the other unit. Your rental income is going to be $1,800, just like the first scenario that we looked at for investing. Our operating costs, again, same thing, 20%. So 20% of $1,800 is $360. So the rent minus operating costs brings us to our net rent income, which is $1,440. Now let's take a look at what you, the owner, will pay if you're a first-time home buyer, which is a 30-year amortization. So our mortgage, which was $2,760.48, minus the net rent income, which is $1,440, brings us to you, the owner, paying $1,320.48. As you can see, this is much lower than the average rent in the area. Now let's look at the other example, which is a non-first-time home buyer, amortization 25 years. So our mortgage payment, which was $3,020.30, minus the net rent income, which is $1,440. They're the same in both scenarios, which brings to you, the owner, paying $1,580.30, still below the average rent. Now let's look at what adding an ADU, a tiny home in the back, can do for ADU for the cash flow. So to buy a tiny home, we're using the same cost just as scenario 1, which is $175,000. So loan payment on that at the same interest rate over 25 years is $977.35. Now let's take a look at what you, the owner, pays if you're a first-time home buyer. So we're doing our mortgage plus now the new loan from the tiny home equals $3,737.83. Now, if you're not first-time home buyer, let's take our mortgage plus the loan from the tiny home, which brings us to $3,997.65. Now we're getting rent from 2 units, each $1,800, which brings us to a total of $3,600. Operating costs 20%, $720. And now our new net rent income is our rent minus operating cost, which is $2,880. So now let's see what the first-time home buyer owner will pay. Our mortgage minus our net rent income brings us to $857.83. That is now your new mortgage payment, way below $1,000 below the average rent in the area. Now let's look at what a non-first-time home buyer will pay. So we're grabbing our mortgage minus our net rent income, bringing us to $1,170.65. Still great, way below the market rents in the area. So as you can see in both scenarios, adding an ADU is a great idea. The more units you have on the property, the more you're going to cash flow, or in the example of house hacking, the lower your mortgage payments are going to be. Whether you're house hacking or an investor, this duplex in Brantford shows you how you can turn a typical property into a powerful income asset. And with space for an ADU, a tiny home in the back, which is a great option for long-term stability. Make sure you always consult with a mortgage broker and a tax specialist before jumping into any real estate decisions, because every situation is unique, and those expert advice can either make or break your deal depending on your unique situation. Want to learn how to run your own cash flow analysis? Click the link in my bio to connect with me directly, or if you'd like to view the property as well. And don't forget to subscribe to this channel for more case studies, property breakdowns, and real estate investing tips. Let's grow your portfolio together.